Unit 7 gets into open economy macroeconomics. We've learned that if an economy is closed, that means it has no trade or interaction with other countries. So, open economy macroeconomics is going to deal very much with other countries. We start Module 41 learning about capital flows and the balance of payments. This is a accounting chart that will show us money coming in and out from other countries in different sectors of the economy. We'll also learn about a new economic model in this unit called the Forex, which stands for foreign exchange, and that will show us how exchange rates are set when you're trading one currency for another. So Module 41 has capital flows and the balance of payments. And this is the idea that large amounts of money are constantly flowing in and out of every country. So in America, Americans buy trillions of dollars worth of stuff. We buy goods, we buy services, but we also buy assets. We can buy savings accounts and stocks and bonds. We can send money to family members and friends in other countries. We can put our money in banks in other countries. And all those things work the same way too. People from other nations can buy American goods and services. They can buy stock in American companies. They can even buy U.S. Treasury bonds, those T-bonds. So there's trillions of dollars worth of money flowing in and out. And economists want to sort where's the money coming from and what sectors of the economy is it going into. All of those things we'll see in this balance of payments accounts, which is basically a very large chart sorting all of this money. Balance of payments for a country is much more complicated than balance of payments for a family. So let's just look at a simplified balance of payments account for one family, which would be a microeconomic model. But this will give us an idea of how this works. So here we have one family over the course of 1 year, and this family runs an artichoke farm. So you can see they have sources of cash. This is categories where cash is coming in. And then uses of cash, these are areas where money is going out. So we look at it that way, and then we break it down further into goods and services, interest payments, loans, and deposits. So they're artichoke farmers. They earned $100,000 in artichoke sales this year, but it cost them $110,000 to operate their farm and for the living expenses of the family. So for goods and services, we look at the sources of cash, the $100,000. We subtract the uses of cash, $110,000. And so for the category of goods and services, they had a negative $10,000. So net is your overall kind of a subtotal for that category. For interest payments, they received $500 in interest from money that they had in the bank. That's money that came in, that was positive, but they spent $10,000 on the mortgage for the farm and the house on the farm. So 500 minus $10,000 equals a net of $9,500 that's negative. So it really matters to us if these nets are positives or negatives. Finally, for loans and deposits, they received a new loan. So they have $25,000 that they had coming in from that new loan. And they also, so this is kind of a in the bank category. And so they earned $25,000. And they also used some of their money to put it back into the bank. They deposited $5,500. So $25,000 minus $5,500, we have a net of $19,500. So you can see that they lost money in the first two categories, gained money in the third, which equals out to zero. It's also important to see across the bottom that the sources of cash total and the uses of cash total are the same amount, so that they, 125,500 minus 125,500 equals zero. So when you add these categories up together, these also equal 0. Basically, everything has to break even. And the main rule of this balance of payments is that all money that comes in goes out. Going out might be putting money into the bank. Going out might be spending money on goods and services. But all money that is earned ends up somewhere. So we need to see where everything is going, and these things should all equal up to 0 if all the money is accounted for. Now that I've shown you one completed balance of payments accounts for a family, you're going to fill this one in. So go ahead as we read through the information on this family, write down the dollar amount where you think they go on the balance of payments chart, and then we'll check over it at the end. So this family runs an auto repair and body shop, and the shop earned $450,000 in sales this year. They spent $400,000 for living expenses and for operating expenses of their shop. And they earned $5,000 in interest on savings accounts that they had and other investments that the family owned. So go ahead and write down, we have 3 different figures here. Make sure you put them where you think each of them go. If you have finished a subcategory, you can go ahead and total the net for that row as well. The Santa Cruz family paid $25,000 in interest on the mortgage for their building, and after paying all of the bills that year, the family took their remaining cash and deposited it into the bank. Now you should be able to figure out what the remaining cash is by adding and subtracting and filling in the holes. We know that the sources of cash and the uses of cash, that these two should equal each other. And that once you look at these net categories, that this should also equal 0. So knowing the things that we do, you should be able to figure out what this remaining cash is. Take a moment and do that, and then we'll go over the right answer on the next slide. Here we have the completed balance of payments accounts. They earned $450,000 in sales. They spent $400,000 in living expenses. So their net for goods and services was positive $50,000. For interest income and payments, they received $5,000. They spent $25,000. Their net is negative $20,000. They did not receive a new loan. There was no information given to you for a new loan. So you know that this total, $455,000, which means that this total must be $455,000. So there must be $30,000 left over that they can deposit into the bank. We also can see that if they had $50,000 net minus $20,000 net, the way to balance that out would be a negative $30,000. So 0 minus $30,000 would also get you there. Now, one thing worth noticing, both families had a balanced balance of payments, right? Everything equaled out how it should. But that doesn't mean that both families are financially doing the same. So the first family, if you noticed, only broke even because they took out $25,000 worth of loans. That is definitely not a good way to have a year in the life of a family business. In this case, this family earned more than they spent, especially in this first category here. Their sales were higher than their expenses to run the shop. They did not need to take out any new loans, and so they had money that they could deposit in profits at the end of the year. So this family is doing much better financially than the first family. So there's a difference between we ended up with 0 and everything's fine versus, well, is that good? In this case, we can look at families, but when we're looking at countries, it's also important to see, are you spending more than you're taking in? Did that country only break even because they had to issue a lot of debt in the form of maybe treasury bonds in America's case to break even that year? For any balance of payments accounts, if it's for a family or for a country, it's really important to see that the sum of cash coming in from whatever source has to equal the sum of cash that is used. So every dollar has a source. We know where it came from. and then it's accounted for later in terms of where did it end up going. So there shouldn't be any unaccounted for money. Now that we've seen balance of payments for a family, we're going to get into what they actually look like on the macroeconomic scale. So we're going to look at balance of payments accounts for nations. So countries also have money coming in and coming out, but we're looking at the world. So we want to see what money is coming in from foreigners from other countries and what money is going out from our country to other countries. So we're going to look at inflows and outflows of funds. Now, this money could come in for all kinds of different uses. So if we're talking about goods and services, that's going to be within the current account. And within the current account, there'll be money coming in and going out. There's also another category called the capital and financial account, and that's primarily transfers of assets. So Americans can buy assets from other countries, and people in other countries can buy assets from us as well. For balance of payments for a country, we have different categories. So payments from foreigners, this is money coming in. And payments to foreigners is money going out. So we still have subcategories. We can still look at the net total of each of those subcategories. Things are still supposed to balance out, but as you can tell here, it's not perfectly clean. We don't have a zero here in the bottom corner. We don't have totals at the bottom, and we'll find out why that is. So the first category, sales and purchases of goods and services. This is really about exports and imports. So payments from foreigners, that's money, and this is all in billions of dollars. Go ahead and fill this all in. So the idea is if $1.827 billion came from foreigners, that's the same thing as $1,827 billion. Anyway, payments from foreigners are for American products, so these are exports. And payments to foreigners, we are buying goods from other countries, and those are imports. So you take the payments from foreigners and you subtract the payments to foreigners to get our net. We have a negative net for goods and services because we import more than we export. Factor income, we're going to talk about that. There's a lot that's included in factor income. The factors of production are land, labor, capital, and entrepreneurship, way back from Unit 1. So we're going to talk about money that we receive for land and labor. Capital gets a little bit more complicated. This will involve investments and stocks and those things, businesses that you own, and then any new ideas, entrepreneurship, if you're receiving payment for that. So again, we have payments from foreigners minus payments to foreigners. We do have a positive net balance in that category. Transfers are really hard to calculate. Transfers are the amount of money that people send to friends and family and loved ones overseas, and vice versa. Now, this does not get directly reported to the government. If you decide to send a family member a Christmas card or a birthday check with some money in it, or even if you decide to send money every single month to family back home, this is not something that we have a form and it automatically gets reported. So the government has to estimate how much comes into transfers, and because of that estimation, we assume that there's more money that's going out of America, people that came here and are sending money home. So we assume that it's a negative net balance, but because we don't actually know this total, it is impossible for us to come up with subtotals here, and that's also why we don't break even overall, because we don't really know where all these dollars are coming and going. Now, estimating that, we have a negative net total here for the current account. We also have something called the capital and financial account. I know this one says financial account, but really it has two names. This is going to include assets. And assets can be all kinds of things, stocks, bonds, certificates of deposits. So we have, those are pieces of financial capital, which is why it's named that way. Now, what's distinct here is not what the capital is, it's who is purchasing it. So official asset sales and purchases are purchased by the government. So if our government took out a loan or from another country, or we loaned out money to someone else, that would be part of the official sales of assets. If an individual person decided to buy a stock or sell a bond or to get a loan from another country, that would be under the private sales and purchases of assets. But like everything else, we take the number, payments from foreigners, subtract payments to foreigners to get our net. Now, this last category, people sometimes get thrown off by the math, the private sales and purchases. So 47 minus 534. If you subtract a negative, you are going to end up with a positive number. So we will talk in a lot more detail about what goes in each of these categories. This is really the complicated part. What belongs in which category? And that can be asked in multiple choice or in FRQ sections. So we're going to focus on what goes into each of these 5 categories. And you also need to know which of the categories are part of the current account and which things are part of the capital and financial account. So keeping all of that straight is the priority of this module. So now we're going to get into more detail about what is included in each category. So international transfers are estimated because we don't have very accurate records of people sending money to family members overseas. These are going to be estimated. And that's why the net total for balance of payments accounts for a country normally isn't 0, like it should be, because we don't have perfect record keeping here. Now, there's a lot of money that goes back and forth between countries. There's all kinds of services that provide international money transfers, sending money to people that you know overseas. So this is not for a good or service. Let's say you buy something off eBay and the person is in China. That would fall within the first category, the goods and services. These transfers are not money for any good or service. These are just money being sent over. Oftentimes people will have family member in other countries that they're financially supporting, or they've moved to a new country and they want to send money to their parents, or maybe they have family that they're supporting that way. So that's what transfers are. This is not paying for a good or service. This is just sending money overseas, usually to loved ones. Factor income gets very tricky to think of what is included and what's not. So first of all, we can see here in this image the 4 factors of production. We have land, labor, capital, and entrepreneurship. So paying somebody for land, you buy property in a foreign country, that would be a factor income. And that one's simple, that makes sense. Paying for entrepreneurship, it's a little bit harder to understand. It is possible that you could be buying a patent or buying an idea from someone, and that could fall within entrepreneurship. But labor and capital are the main ones that are a little bit complex. So if you're paying someone for their labor, maybe it's someone who is born in this country but they're working overseas or vice versa, and that can become very complicated. So if we have American workers working abroad, that is still payment to American workers. Capital, or we're talking about financial and physical capital. So if you own a piece of stock, that is financial capital, and those investments can earn you interest payments. That would be part of factor income. If you have issued a loan to someone in another country and you're earning interest on that, that's also physical or financial capital, and you can earn interest there. Or any profits that you have from anything that you own. So not just a stock or a bonds, but you could also own a corporation. Maybe you own a piece of rental property in another country and you're earning profits on that thing. That's all part of factor income. Now, this confuses people because they don't know how to tell the difference between an asset, which would be part of a different category, or factor income. And factor income, first of all, it has to be one of the factors of production, but that's pretty broad actually. What makes it part of factor income specifically is that the transaction is complete. So, buying a foreign-owned corporation, you're actually buying an asset because that purchase is going to continue having value into the future. But this year's profits that you earned are part of factor income because you got paid. Done. Transaction is complete. You might get paid again next year. Maybe you lose profits next year. We don't really know. All we know is that you've earned money this year. You got paid. Transaction is complete. That puts it into factor income. And that puts it in, and factor income is within the current account. It's called the current account because these transactions are things that are finalized within that year. And you don't have money definitely changing hands into the future, unlike assets, where we know those things will continue to have money coming and going next year and the year after. Assets can include two different categories. Physical assets are physical things that you can see, touch, and feel. So you buy a factory, a company, a piece of equipment. You're buying that thing because it's worth value to you today, but you also assume that that factory, that company, that piece of machinery will continue to be valuable next year and the year after and the year after. Assets have worth that continues beyond the calendar year. So that's physical assets. Financial assets are pieces of paper that represent worth, stocks, bonds, and CDs. Again, you would like to earn a profit this year, but you also would like to earn money next year and the year after. So assets that continue to be worth value would go under this capital and financial account. But profit earned from any of those things, you earn money from the company, you earn money from a bond, those are all part of the current account. You got paid, that transaction has been completed. So this is what's confusing, that there's an overlap between buying an asset versus earning money this year off of that asset. So owning a company is an asset that would be part of capital and financial accounts. But profits earned is factor income, and factor income is a part of the current account. So knowing that there are definitely some categories that are harder to keep track of, let's think of which category this would be, the 1 through 5, by name, and also is it a payment to foreigners or payment from foreigners? So go ahead and do 1 through 4, and then we can check your work. So pause it here, see what you think. Feel free to flip back to the chart to remind yourself about the categories. So when you're ready, the number 1 question says, U.S. exports cars to be sold in Canada. Now clearly that's going to be a good and service, but the question is, which country is getting paid? America or Canada? America is, therefore it's a payment from foreigners. So we got to think about the category of the transaction and then which country actually gets paid. Next one, Walmart, an American company, earns profits from stores in Europe. So think about which category this is and then which country is getting paid. Here we have factor income payment. So buying or setting up a whole new Walmart store in a foreign country would be an asset. But this year's profit is factor income. And the fact that the American company is the one that's getting paid makes it payment from foreigners. Number 3, Mexican-born workers employed in the U.S. send money to their families in Mexico. So we have transfer payments because they're sending money abroad, and the people that receive the money are in Mexico, therefore it's payment to foreigners. Number 4, Coca-Cola buys a factory in Australia. Okay, little hint, the factory itself is going to be the asset. Now, if Coca-Cola is buying it, is that official or is that private? And then which country got paid? All right, it is a private asset. Coca-Cola might be a major corporation, but they're not a government. Only governments and central banks of the government are considered official in terms of official purchasing of assets. So Coca-Cola is private purchasing. And Australia is getting paid, therefore this is payment to foreigners. Please do these 4 practice problems again on your own. If you need more time, pause the video and then we'll go over it. So U.S. import oil from Venezuela. Oil is clearly a good, and the fact that Venezuela got paid makes it a payment to foreigners. The next one, the Central Bank of China purchased a U.S. Treasury bond. So the Treasury bond is an asset, so would this be an official or a private sale? This is official. Remember, official includes both governments and central banks. And because China paid America for this asset, it's a payment from foreigners. Next one, Honda, a Japanese company, produces and sells cars in Indiana and other U.S. states. Now this one is tricky. There's a difference between Honda setting up a brand new dealership versus Honda selling product this year. The fact that this is just Honda selling product and they're earning money off of the company that they already own makes it factor income. If they were setting up an entirely new Honda location, that would be an asset. So that's the distinction to keep in mind. And because the money, Americans are buying these goods, but it's going to a Japanese company, therefore it's a payment to foreigners. And the last one, a Brazilian company buys an apartment building in Boston. Apartment buildings might sound like a good or service, but they're not. This is something, if you buy an apartment building, we can assume that you're planning to rent it out. And that rent will continue to bring in money into the future. That makes us an asset. And because it is just a privately owned company, this is a private purchase of an asset. The money went from Brazil to America, so it's a payment from foreigners. So I hope we've been noticing that the major difference between the 2 large categories is whether or not they affect the future. So current accounts are the first 3 rows, and all 3 of these transactions can be completed within 1 year. You bought the good or service. You earned money for your labor. You sent money to a loved one. There's nothing that says that you will absolutely, without fail, do this thing again next year. There's no contract that locks you in to doing it again. So those things are current accounts. They have been taken care of. Money has changed hands. Done. Whereas all of these assets are things that are going to have future liabilities. They will be worth money in the future. So the capital and financial account does have future liabilities. We expect money to change hand again. Current accounts don't. We keep talking about it, so current accounts do not create liabilities. These 3 categories we have: goods and services, factor income, and transfer payments. Once you buy the good, you don't have to buy it again. So here we see an American buys a jacket produced in Honduras. That would be a payment to a foreigner for a good or service. You might buy another jacket again next year, but we certainly don't know for a fact that you will. So this transaction has been completed. That puts it within the current account category. Here are 2 new terms that are really important to keep separate for current accounts. So the balance of payments of goods and services is the difference between the value of everything that we export to the world, as well as the value of the imports that we receive from the world during a given year. And you can see if we have a positive or negative balance of payments for goods and services. Now, oftentimes people speak of the trade balance. The trade balance is just exports and imports of goods, not services. So buying products overseas, we would see in the trade balance. But let's say you paid someone in a foreign country to help you with your travel plans, or to teach you a foreign language, or to help schedule your trip. There's all kinds of things that people do in terms of services. Those would be part of the first category, but we wouldn't see them in the trade balance. So trade balance is a much more specific, smaller part of the overall balance of payments on goods and services. So capital and financial accounts do create future liabilities. It doesn't matter who is buying the asset. It could be a private purchase or an official purchase, but assets have continual liabilities into the future. You hope that they will continue to bring money in, but you might lose money on that stock next year. But either way, there will be some sort of impact on your bottom line on how much money you have from that asset next year. So if a Honduran banker buys a U.S. Treasury bond, even though they're a banker, that's not the same thing as the central bank. So you would still call this a private purchase of an asset, and it's a payment from a foreigner. But that person who bought the bond, the U.S. government will need to pay them back when this bond matures, and that is a future liability. So both categories, current accounts or capital and financial accounts, can have a deficit or a surplus. So if we import more than we export, for example, that means that we're buying more from the world than the world is buying from us. We could potentially have a trade deficit. So we can look at any of these categories and see, is more money going to foreigners or from foreigners, to see if there's more money coming in or going out, to determine, do we have a deficit in that category or a surplus in that category. They almost never are going to be perfectly zero. So you're usually going to have one or the other. Now, because current accounts and capital or financial accounts have deficits and surpluses, that means that one of them is going to be positive and one of them is going to be negative. And what's interesting is that they always equal zero. When you add them together, the current account, CA, plus the capital and financial account, CFA, equals zero. And this is only possible if one of them is positive and one of them is negative and they equal out to zero. The reason why, as we've seen with all of these balance of accounts, is that sources of cash must equal the uses of cash. What comes in must equal what goes out. So if you are receiving a ton of money in the first category in current accounts, a surplus, that money is probably going into banks, into assets and things like that, so you'd have money coming out in the next category. Now we know that this isn't necessarily always going to be perfect, because transfer payments especially are very hard to get exactly right, but they should equal zero or get very close. You're never going to have a surplus in the current account category and a surplus in capital and financial accounts. That is impossible. Let's see how this really works. So suppose that imports exceed exports. That means that we are buying more from other countries than the world is buying from us. Now, because we're talking about imports and exports, does that sound like the current account or the capital and financial account? That's CA, the current account. Now, would that account have an inflow or an outflow? If we're buying more from the rest of the world, then we have an outflow. Money is leaving in this category. If we have an outflow, does that mean we have a deficit or a surplus? That means we have a deficit. There's more money leaving this category than coming in. In order to buy more than you sell, so to keep up with this imports exceeding exports, you have to borrow from the rest of the world. So in order to get money to pay for all of these goods, we're going to borrow. Does that sound like CA or CFA? It's the capital and financial account. So maybe we're buying some investments, we're selling some of our own stocks and bonds and those things in order to give us money to buy all these products that we want to. And for that reason, we need to take in money from other countries to pay for stuff. We're borrowing, so we're going to have an inflow or a surplus of funds in that category. And these things all balance each other out. So we could potentially look at this in terms of a circular flow model showing international transactions of inflows and outflows of funds. So like any circular flow model, the value of the money flowing into a box must be equal to the value of what's flowing out. So if the United States is paying the rest of the world for goods and services, maybe there's more money coming from the US to the rest of the world and therefore less money coming back. And we would need to make up for that by increasing the amount of assets on both sides. So these can all stay equal. The current account shows us trade balances and net exports and things like that. The capital and financial account is showing us capital inflows. Remember, capital inflows are all about savings. This is not the inflow of goods and services. This is about money going into banks. And when capital inflows come from the world, that means that our banks have more money that they can use to issue loans to finance domestic investment spending in your country. The capital inflow equation, just to review it, is the total inflow of money from other countries, inflow of funds, minus the total outflow of funds from your country to other countries. So if there's more money coming in than going out, you would have a positive capital inflow. If there's more money going out than coming in, that means that you are sending more money to other countries than they're sending to you. You could have a negative capital inflow. Now, capital inflows are a shifter of the loanable funds model. So let's go ahead and review this for a minute. Make sure we remember what sort of impact capital inflows would have on our country's ability to loan out money to finance that domestic investment spending. First of all, this model isn't even remotely labeled correctly, so let's make sure that we remember how. For loanable funds, which interest rate are loans in? Loans tend to be long-term, longer than a year, so will you notice the effect of inflation during that loan? Yes, so we will need to adjust for inflation, so we're going to need the real interest rate. We already have, this one's actually correct. Quantity of loanable funds is totally accurate. That's just fine with us. Now, supply and demand are not good enough, so we need to have the supply of loanable funds, the demand of loanable funds. For subpoints here, the bottom of equilibrium, Q is just fine. And over here, the equilibrium interest rate is R. Okay, just wanted to refresh that. Now that we remember how the loanable funds market looks, which line is affected by capital inflows? Which one would it shift? Well, capital inflows are not people coming to America demanding a loan. They're people that are sending their savings into our banks. Therefore, that's supply of loanable funds. So if more capital inflows are coming into America, that means American banks have more money they can loan out. So it would shift supply of loanable funds to the right. That creates a higher quantity of loans that are possible in America, which are always good. We like that. And it also lowers the real interest rate. So it absolutely benefits our country to have people from other countries saving money in our banks. It allows us to have a higher quantity that we could loan out to businesses at a much lower rate. Every model needs assumptions to work. This assumption will be based on exchange rates. We haven't talked about these much yet. They're going to be really important later on in this unit. But the exchange rate is the relative value of a currency. So for example, how many euros buy $1? How many pesos? How many yen? How many francs? There's so many currencies in the world, and exchange rates are the price of any given currency in terms of how much of another currency it takes to buy it. So here you can see that 1 Swiss franc will buy 80 Japanese yen. That's the exchange rate. Now, if people are sending tons of their currency over to America in capital inflows, it does affect exchange rates. But it's very hard for us to see the effect of that because we don't know necessarily which countries and therefore which currencies are the ones contributing to our capital inflows. So for this to be a simplified model, we're going to assume that the exchange rates don't change when capital inflows increase or decrease. We're going to keep that part set. Before you do the real interest rate, loanable funds drawing in your notes, let's do one together. So here you can see the loanable funds markets for 2 different countries. We have on the left, we have the United States, and on the right, we have Britain. So what is the equilibrium real interest rate in the United States? 6%. And the real interest rate in Britain is 2%. Countries do have different real interest rates. That's an actual thing that occurs. Now, if you are thinking about capital inflows, that means you are a saver. And I can decide where I want to save my money, what country I want to save my money in, what bank, what type of account. I have lots of choices. So if I am a saver, am I earning interest or am I paying interest? Savers earn interest. Therefore, they're going to want to save their money in the place where they're going to get the most out of it. So people in the United States are going to choose to keep their money in the United States because they'll earn more interest. But that also means that people in Britain could decide to send their money overseas and to save in American banks where they will earn a higher real interest rate than they would if they kept their money at home. Considering the fact that the United States has a higher real interest rates than Britain, we talked about how people in Great Britain would feel compelled to save their money in American banks. So especially if both countries view the other option as an equally good choice, an equally safe choice. So as you know, there are some countries that don't have banks that are as high quality in terms of, is your money protected? Is it guaranteed? Is the currency stable? Will the interest rate change again tomorrow? So as long as they each view the other country as a safe choice compared to their own country, what will they do? So if British people decide to put their money into American banks, then the supply of loanable funds in America will increase. And as you can tell, when that happens, it starts to lower the real interest rate. Because they took their money out of British banks to put them into American banks, it decreases the supply of loanable funds in Britain, which has the effect of raising interest rates there. So this all occurred because interest rates were higher in America. Well, it won't stay that way. The act of these capital inflows moving actually starts getting these interest rates closer and closer until they eventually meet in the middle and have the same real interest rate. So imagine that being a straight line. If they're 2 equally good options, the interest rates will eventually equalize. Now let's try one on our own. Looking at 2 different loanable funds markets, we see the one on the left is from US and the one on the right is from Japan. The equilibrium interest rate in the United States is 3%, and the equilibrium interest rate in Japan is 7%. So if you were a saver, which country would you decide to save your money in? Japan is the wiser choice as long as you feel like your money is safe in Japan because you'll earn a higher real interest rate in those banks compared to American banks. When 2 nations have different real interest rates for loanable funds, savers in the country with the lower real interest rate will decide to send their savings, their capital inflows, to a country with a higher real interest rate where they'll earn a bigger return on the investment. In this case, their currency is an asset that they're investing. They realize that if I have money I'm not using, I could put it into a bank one place and earn a certain amount, put it in a bank somewhere else and earn a different amount. So their currency is functioning as an asset, the amount in savings they're going to earn money on. So, individuals and firms in the US are going to buy financial assets in Japan. Maybe they'll buy a bond or a certificate of deposit in Japan that has that higher real interest rate. So, the asset is coming to America from Japan, and Americans will send their dollars over to Japan to pay for those assets. So, in essence, when Americans decide to send their money abroad to earn a different amount of interest, they're exporting dollars, they're sending their dollars over, and they're importing financial assets. So if they decide to buy bonds in Japan, those Japanese assets are coming across, and they send over US dollars, which they'll convert to the Japanese currency, yen, in order to pay for them. From Japan's point of view, they are exporting those assets, those bonds, those CDs, and they are importing American dollars into their banks. That gives them an increased supply of loanable funds. So it's important to keep straight that U.S. investors are buying financial assets, not physical assets. So physical assets are those things that we can see and touch, factories, equipment, and companies. You don't earn a set interest rate on physical assets. So high interest rates in Japan will not in any way impact our purchase of physical assets. Financial assets, on the other hand, bonds, especially in CDs, do have set interest rates. So if interest rates are higher somewhere else, then people are going to want to buy those assets to earn those higher interest rates. Let's see how this looks on the loanable funds models. So as Americans decide to put their money into Japanese banks, they're going to take them out of their bank accounts. So the supply of loanable funds in America decreases. So what happens to it? It decreases, it shifts left. As that occurs, it's making the real interest rates in the US increase. And it makes sense that our supply of loanable funds is decreasing because we're taking money out of a place where we're going to earn lower interest and putting it into a place where we'll earn higher interest. So as we take money out of American banks and put them into Japanese banks, the supply of loanable funds in Japan increases, which has the effect of reducing their real interest rates. And it's worth noting that they meet in the middle. So the USA started at 3 and Japan started at 7. But as those capital inflows start to shift, they're both going to meet in the middle, and the middle of 3 and 7 is 5%. So the act of moving funds around has an overall effect on the interest rates of the country. It's also important to see that because Americans are deciding to put money into Japanese banks, that is outflow from the US because money is leaving the US. And it's an inflow to Japan because those loanable funds, those savings, are going into Japan. Did you draw those shifts on your notes? If not, go back to the last slide and make sure that you draw the shifts. You want to see that supply of loanable funds is being impacted in both countries, and that the supply of loanable funds decreases in a country with a low interest rate and increases in a country with a high interest rate. You're going to need to know that to make sure you've drawn it. Moving forward, so the dollars that are going from US to Japan are going to be inflow into Japan and outflow from the US, as we saw. Whichever nation has a higher real interest rate attracts inflows of financial capital into their country. People want to earn higher interest. They want to buy those bonds and those CDs. So inflows flow into countries with high real interest rates, and they flow out of countries with lower real interest rates if people feel like they have a choice to save their money elsewhere and to earn higher real interest rates. The rule that we just saw about real interest rates equalizing, going up in countries that had low interest rates and going down in countries that had high real interest rates, that rule does work, but only if both nations are viewed as equally good choices. Is this a safe place to get a loan from? Is this a safe place to save my money? What if there's a bank run? Will the government take over these banks? Is there corruption? Is there rapid rates of inflation that'll impact the value of my money once I switch it over to their currency? So real interest rates haven't just equalized all across the entire world because countries aren't viewed as equally safe places for capital inflows to go into. Let's get into some other factors that will affect both demand and supply for loanable funds. Remember, DLF stands for Demand of Loanable Funds. And demand is not the same around the world. Some countries demand more loans than others. And a major factor for this is the growth rate. Countries that are growing very quickly, so we're talking about developing nations, maybe third world or second world countries, are going to have more investment opportunities. They are building up their infrastructure, their highways, their railroads, their internet, their electricity grids. And all of these things are great places for people. If you're an investor, if you start at the beginning of an investment, think about it like a startup business. High risk, high reward. You're coming into the beginning, so your money can grow really rapidly. Countries are the same way. If their economy is growing rapidly, international investors look at it in terms of, I can put my money here and see a huge return on my investment. People need loans. There's all kinds of things I could loan money for, and also I'm going to get a lot of money back. Whereas if I chose an established company that's been around forever, or even a country that has low rates of growth and is fairly stable, there's going to be a smaller window of growth in terms of my investment, in terms of how much I can get back on what I put in. So rapidly developing nations have a lot to invest in, and they have a large potential to make you a lot of money. Now, you might lose all of it. They might not have a stable government yet, and so that return might not be very safe, but people view it as a high risk, high reward situation. So capital flows from slowly developing nations to rapidly developing nations. In the picture here, we can see all of the countries that are investing money to develop things in sub-Saharan Africa. There's a lot of areas for growth, and while it might be a risky place to invest in, people realize that they might earn a lot of money back. So the demand of loanable funds is higher than in a place that's more established. In terms of supply of loanable funds, the major difference there is all about savings, because savings impact the supply of loanable funds. And some countries have higher rates of private savings than others. In terms of, does the culture value savings? Does the country reward savings? Do you get tax rebates for savings? Do we give you incentives to save? Are the banks considered safe? And also different savings rates by the governments of those countries. Countries that run a deficit year after year after year are not saving. Countries that have surpluses, their governments are saving money, and they have more saved away, and they wouldn't need as many loans in the future. Now, governments with deficits are not doing national savings. Remember, private savings is savings by households, national savings is savings by the government. If the government has a deficit year after year after year, then they need other people to loan them money to make up for that deficit. So people from other nations can send money in to meet that demand, which leads to capital inflows. So in places that have shortages, the demand for loanable funds exceeds the supply for loanable funds. People from other countries can come in and fill that gap. Now, we know that if the government has a deficit, that will shift demand for loanable funds. And when they take up a lot more of those loanable funds, that creates something called crowding out, where there's fewer loanable funds available for everybody else. So there's a shortage of remaining loanable funds. So in places like that, other countries can come in, they can bring in the loans, especially if they know that the laws of that country are in their favor, and that, if people default on their loans, there's going to be some protections for the lenders. So capital inflows can come in and make up that difference. Up to this point, we've talked about the fact that capital inflows are either going in or going out. But in reality, there's oftentimes two-way capital flows. Maybe there's some assets coming in and assets going out. And interest rates are not the only thing that you would consider if you decide to keep your money at home or to send your money to another country. So what are some other factors beyond interest rates that would impact capital inflows? The first one is foreign investors might want to diversify. Diversifying is all about spreading out risk. And if all of your money, of all of your investments are in one country and in one economy, what happens if there's a recession in that country? Or if there's inflation in that country? Sometimes foreign investors want to diversify and spread their risk out by investing money into different countries. Also, businesses might choose to expand into other countries. They are deciding to open up new locations. Sometimes countries offer tax incentives for businesses to start up there. So you'll see money flowing overseas. That would be an outflow of funds as businesses decide to start new locations somewhere else. Also, there could be incentives for people to bank in other countries. I'm sure you've heard about Swiss banks. They have some incentives for companies in the sense that they have some secret accounts that aren't tied to anyone's name, and they can encourage people to send money there. There's other countries that are called tax havens, where you can save money under, it's called a shell corporation, where you make up a company's name and then you save your money there. So it's not tied to you, it's tied to this corporation that you might be in charge of. But if the US government doesn't know that you're running this corporation, then you're not reporting your income and you're not paying taxes on your income. So sometimes people in other countries try to encourage foreign investment savings to come into their country by all these creative means to get money flowing into their country and out of your own. So because of all of these complicated factors, most modern economies are both debtors and creditors. Debtors, people that are in debt, owe money to the world. Creditors are people that are lending out money and the world owes them. So maybe we have a loan from one country, but some other country has a loan from us, and vice versa. And most countries are like that. There are some countries that are just in debt or that are just creditors, but usually it's a combination. And you might be a debtor to one country and a creditor to another.